attributed to Made in China. A large number of cheap goods from China came to the United States, and a huge trade surplus created a foam in the housing market. If it was a foam, it would inevitably burst. Another approach is to point the finger at international accounting standards as when the president of ICBC believes that these standards adopt using fair value i.e. market transaction price to value financial assets results in a pro-cyclical effect, a decrease in transaction price, withdrawal of provisions, reduction of equity, panic selling, further price decline, continued provision and reduction, ultimately driving bear stearns and laymen to the brink. On the surface, these views may seem reasonable, but the common flaw is that blind people touch the elephant and a leaf barrier eyes either have linear thinking or are captured by knowledge, failing to penetrate from the surface to the inside and explore the essence of the crisis. Regarding the outbreak of subprime mortgages, Farker believes that it is fatalistic and essential. 1. There must be a foam in finance, and it is normal to liquidate positions by evaporation. From the initial stage of market economy development to the advanced stage, finance has broken away from the self-circulation of the real economy and built in the original sin of excess. Excess must have foam, foam must evaporate, and excess must be liquidated. This is the internal law of financial operation. 2. Financial civilization has pushed foam and evaporation to the extreme. The explosion of derivatives gave birth to financial civilization. The former was cut and sold like 1,000 layers of sects, and the world was included in the game of drum eating and flower spreading, which magnified the foam infinitely and evaporated unprecedentedly. As for the main ways of evaporation, there are 2: asset write-offs and write-downs. According to Bloomberg statistics, as of August 18, the global cumulative asset write-downs and credit losses had reached $503.6 billion, of which the United States accounted for $252.8 billion. Europe, which was greatly affected, accounted for $228.1 billion, and Asia, $22.7 billion. Since October, the fourth largest bank in the UK, Royal Bank of Scotland, has written down its assets by £5.9 billion, and organisational loopholes have triggered huge write-downs of UBS Group's assets, indicating that the write-down tide has not ended. The evaporation of virtual assets. According to the Daily News of Japan on October 11, the stock markets in Japan and the United States have fallen by 35% to 45% since 2008, and the total market value has also sharply shrunk. If the losses of Europe, emerging markets, and financial home country, but also the global interests, too big to fail, has subverted the traditional free market, and the long-term capital management crisis of the 1990s also hinted at the intervention of the U.S. Federal Reserve to rescue investment banks. There will be no problem with the Federal Reserve playing around underneath The inclusion of Fannie and Freddie is conclusive evidence, while the collapse of Lehman was due to it's not big enough. Another type of viewpoint focuses on bombarding monetary mechanisms and financial regulation. 1. The foam of technology. Why stocks burst in 2000 later. Years of low interest rate policy caused excessive money supply, which triggered the foam in the property market, and then planted the root of the future subprime mortgage outbreak. 2. Monetary dictatorship is the institutional reason for excessive money supply and foam. Zionian pointed out that the Federal Reserve is essentially a monetary dictatorship. It is the central bank that has the final say, and the central bank is Alan Greenspan who has the final say. Absolute power leads to absolute abuse. In contrast, the Europe and central bank cannot supply currency at any time, and all 17 member states have the right to deny it. Monetary democracy avoids the institutional flaw of currency abuse. 3. Nearly 10 institutions, including the Federal Reserve, the Ministry of Finance, and the Stock Exchange, have been in a state of monk umbrella due to overlapping authorities and regulatory gaps. The U.S. government basically does not regulate commercial institutions. The Big Four accounting firms and other institutions have a basic understanding of their business, with Wall Street jokingly stating that only Merrill Lynch can understand layman's reports. This type of company can only hold onto the final line of defense by shareholders themselves. But for the sake of equity incentives, they completely abandoned the comrade plus brother partnership system of Wall Street entrepreneurial investment banks. After going public, the equity of investment banks is extremely dispersed, and there is no strong shareholder to constrain the management. In addition to investment banks, monetary mechanisms, and financial regulation, the culprits of subprime mortgages are also those who believe that Bush is difficult to dismiss blame. At the beginning of his term of office, he won the hearts of the people and announced that Americans would have their own homes. As a result, the poor people blindly borrowed money, while the banks played smart and blew up the subprime foam. Essentially, officials fooled voters and finance fooled society. Therefore, in this crisis, Bush was the initiator, developers were the manufacturers, and investment banks were the detonators. The other is, institutions are also included. The global financial asset losses in 2008 reached as high as $27 trillion. 3. The United States was the first to stumble in the early stages of financial civilization. As the bridgehead of financial civilization, nearly 60% of global financial derivative products are piled up in the United States. Previously, both the country and the people have benefited from the world's financial civilization. But now it is reasonable to overturn the ship first. 4. After evaporation, the economy will return to health. 3. Is Wall Street the source of evil? Wall Street, once synonymous with turning stones into gold and becoming wealthy overnight, was a place of worship for financial activities. Not only have they achieved investment masters such as Buffett, Soros, and Graham, but they have also given birth to several big investment ain't banks that can shine in the global financial market. Now, it has become a synonym for naked greed and fraud overnight, and the source of evil that everyone can punish. In most people's eyes, from the subprime mortgage crisis to the bankruptcy of Bear Stearns and Lehman, it has repeatedly exposed the looting nature of virtual financial capital corruption, irrational speculation, and even market manipulation. The fact is true, but it's far from that simple. Firstly, although the high salary culture did not make Wall Street's high managers are more responsible, more arrogant, but this catastrophe once in a century is not explained by the conspiracy theory or greed theory of some interest groups. From the source, tragic fate is a composite of common sins only concentrated on Wall Street. The essence of the subprime mortgage crisis is that the asset inflationary consumption model is unsustainable. It is the hegemonic role of the United States and the overproduction growth model represented by China that have supported its excessive consumption model. The former makes it possible for the excessive issuance of U.S. dollars, the return of excess U.S. dollars, the U.S. consumer credit boom, while the latter ultimately leaves Americans with little worry behind inflation and resource depletion. Use tomorrow's money to fulfill today's dream. In this process, the expansion of asset prices, especially house prices, has become the joint point of consumer credit expansion. But house prices cannot rise indefinitely, and consumption cannot overdraft indefinitely. The subprime mortgage crisis broke out in the context of such a global macroeconomic imbalance. Secondly, in terms of the laws of financial capital movement, the outbreak of crises is not only artificially manipulated and distorted, but also built in. Fokker has always believed that the market economy is inherently guilty of excess evaporation, especially in the free and open financial field. The financial crisis has never been interrupted for 10 years, as evidenced by the Latin American crisis and the crisis of U.S. savings and loan institutions in the 1980s, the European exchange rate crisis and the Asian financial crisis in the 1990s, and the Wall Street to investigate its root cause, stealing forbidden fruits. The human weakness that cannot resist temptation inevitably leads to excess for exchange or trading. When the transaction becomes complex, human beings are often troubled by their own bounded rationality, at a loss. Plant in the seeds for the evaporation of positions, that is, financial transactions must lead to money surplus, and the surplus will evaporate. Recently, Greenspan publicly admitted that his view that banks will do their best to protect the interests of shareholders out of their own interests was incorrect, essentially because he did not see the original sin of finance and ignored the weaknesses of human nature. Finally, whether they are flocking to Wall Street or sneering at it, they still cannot be separated from either this or that. Neither right nor wrong. The misconception of linear thinking is that understanding financial capital represented by Wall Street requires thinking in more dimensions and at a larger level. Firstly, finance fundamentally affects today's human economic activities. Why has China's money increased over the years of reform and opening up? It is not only the material wealth that has greatly increased but also the modern market, property rights market, stock market, real estate market and financial industry that have revitalized, flowed, and realized the previously static land, natural resources, and even the potential future income of individuals and enterprises in China. In other words, when people are indignantly attacking Wall Street, they forget that the so-called wealth and profits they passionately pursue mostly come from the creativity of financial capital. Secondly, has also partially changed people's production, trading, innovation, and lifestyle, from commodity pricing to enterprise risk management. The financial market plays an important role. After the dot-com bubble burst, a group of global leading high-tech companies grew up in the United States, showing that finance promotes innovation. Paperless money, wealth management, etc. are also increasingly becoming a sustainable and irreversible way of life. In summary, it can be seen that this financial storm is actually an evolutionary process created by humans and then counteracted by them. Just like the climate crisis to industrial civilization. Correspondingly, it also means that human beings have shifted their attitude towards Wall Street from ambiguity to mutual intervention and gaming. The demand for capital market fundraising and trading is still there. Talent and brands are still there. And the innovation activities of financial capital will not stop, and may be more tempting and universal. In Europe and Japan, the former has a deeply rooted post-industrial civilization, and the crisis has further stimulated the rejection of finance. They either view it as a monster or want to catch the culprit, indicating that it is difficult for them, except for the UK, to fully enter the financial civilization for a while. Japan has long coveted the financial air supremacy because of the Plaza Accord, so it can't wait to copy the bottom of Wall Street. But it doesn't know why. Because in the financial game of beating drums and spreading flowers, the so-called air supremacy may also become a self-destructive right. As for China, on the one hand, the collapse of enterprises and the winter are intuitive and obvious. After all, since this crisis is the result of global economic imbalance, can also be seen as an adjustment to the imbalance, which is a total adjustment to the excessive consumption capacity of the demand side and the excess production capacity of the supply side. On the other hand, Fokker had already judged more than a year ago that China was following the footsteps of the United States and the United States, blindly entering the financial civilization. Although the subsequent surge in stock indices and the instantaneous expansion of market value were not sustainable, the number and scale of institutional investors such as funds, QFII, and QDII, as well as the billions of individual investors, the financial asset equivalent that still accounts for half of the stock market, and the degree of securitization of state-owned assets indicate that the Chinese economy is undergoing profound structural changes. Therefore, despite the outbreak of the crisis, it cannot be stopped. And of course, the challenges are unprecedented. The uniqueness of China's economy has always been that it has never developed linearly, but rather through several civilizations, agriculture, industry, information overlap each other. Several mechanisms, state, market, enterprise interlace each other, and the game rules dominated by several subject state-owned enterprises. Foreign enterprises, private enterprises collide and run in with each other. It is also the coexistence of several stages: competition, surplus, evaporation, and the combinatio of several concepts: borrowing, pragmatism, the golden mean. So that everything in China's economic reform and development is unprecedented. The arrival of financial civilization, which is difficult to predict, will be even more so. However, this at least indicates that China will repeat the old path of Wall Street. Subprime loans burst. Investment banks evaporated. The United States went crazy. Iceland went bankrupt. And American finance capitalism was stepping into the idle at dusk. Although the global market rescue climax followed, from Paulson kneeling for the approval of the rescue plan, to the unprecedented interest rate cut by the global central bank, to the storm of bank nationalization sweeping Europe and the United States. Europe injected nearly $2 trillion to rescue the market, to the default of domestic management to rescue the property market. The central bank Rely intervened in the interbank market interest rate temporarily. But as the crisis left the focus of Wall Street and moved rapidly to Europe, Japan, and other regions, the constantly escalating financial sweeping has caught the world off guard, with middle and lower class societies in Europe and America either facing high levels of debt or bankruptcies, yet panicked like a turkey waiting to be slaughtered, hijacked by uncertainty and panic theories. On the other hand, in China, although there have been no major fundamental issues and senior executives have repeatedly stated that China is confident in maintaining financial stability, the State-Owned Assets Supervision and Administration Commission (SASAC) has been urging central enterprises to carefully invest in the stock market from September 19 to October 13, which has revealed that relevant departments have also been kidnapped by fear. Fear originates from ignorance. Who are the perpetrators of subprime mortgages? Almost all want to be hit right away. The culprit was brought to justice to vent his resentment. From the existing perspective, the culprits are as follows. One type of view holds that investment banks are the mastermind, excessive innovation and excessive leverage resulting in playing with fire, self-immolation. From 2003 to last year, the leverage ratios of Merrill Lynch and Goldman Sachs skyrocketed to 28 times, while those of Morgan Stanley were 33 times. And those of Lehman before bankruptcy were 30 times. This does not include the leverage effect of off-balance sheet businesses such as sieves. If these leverage factors are included, the leverage ratio of Wall Street investment banks can be as high as 50 to 60 times. The CEO murdered Lehman, and the evil flowers of greed, fraud, and ignorance in human nature caused the investment banks so to capsize. Under the temptation of huge bonuses, luxury homes, airplanes, and yacht beauties, the greedy nature of Wall Street's golden boys is extremely inflated. Under the guise of innovation, they forcefully turn substandard subprime products into popular goods in the market, deceiving many ignorant people to participate in the beating drums and spreading flowers, believing that even if unlucky people emerge, they will only be the last few mice to be hooked. As for themselves, they walk away with high salary commissions. Regardless of the flooding, the outbreak of the subprime mortgage crisis is fatalistic and essential one. From the original sin of market economy to the original sin of finance, the market economy has improved production efficiency and produced more and more products far exceeding market demand, a large amount of surplus products. So excess is an inherent characteristic of a market economy and is innate. As long as the market economy exists and plays a leading role, excess will inevitably occur. Product surplus is an iron law that cannot be circumvented by a market economy, and it remains unsolved to this day. In the early stages of a market economy, surplus was mainly manifested in the form of products, and surplus products ultimately emerged as economic crises. The method of digestion is actually ultimately wasted. In the advanced stage of market economy, which is characterized by developed financial markets and massive financial transactions, the main symbol is that the trading of financial derivatives such as futures and options occupies an important position in the economy, which is known as the virtual economy. Financial markets are relatively developed, and excess commodities evolve into monetary forms, manifested as currency surplus. A free financial system not only provides opportunities for extraordinary returns, but also has the ability to generate spontaneous errors ability, because financial innovation has its special rules. When the capacity is increasing, the player's psychological fluctuations are becoming more and more intense, and it is extremely difficult to balance their grasp of risks and opportunities. Numerous lessons have proved that this cannot be solved by improving management technology. Why? Or even that staged foam and crashes are inevitable. Economists will come up with two different explanations for this vulnerability. One is about the impact on incentives, rational reaction. Another is about human myopia. The difference between the two lies in greed and stupidity. Enthusiasm for financial innovation and risk-taking gave birth to the rapid growth of credit, which in turn pushed up asset prices, making it reasonable to expand credit on a larger scale and higher asset prices. Then, asset prices will hit a peak selling climax, credit freeze. A large number of people will lose their ability to repay, and finally enter recession. Therefore, a credit system captured by human nature is inherently unstable and prone to instability. 2. The destiny and essence of the subprime mortgage crisis. And one of the important lessons of this crisis is that regulators have to help people manage the complexity of the financial sector and resist temptation. One of the main causes of the subprime mortgage crisis is that borrowers do not understand the loan terms, and even if they read carefully, they will still be confused. Therefore, improve information disclosure to make financial products easier to understand and identify risks, rather than anti-innovation and anti-rule simplification. In addition, China's industrial civilization mainly focused on processing and manufacturing has come to an end, facing the elimination and transformation of outdated production capacity transfer and undertake new industries. After this round of reshuffle, Chinese enterprises will face the challenge of building true industrial competitiveness, and it is unknown whether there will be large enterprises that will rise to the forefront of the world. Furthermore, financial civilization is brand new to both China and the world, and there will be more and more uncertain and skewed phenomena in the future. For example, this crisis is seen by most people as a typical black swan event, but the fact is that there were foresight and warnings in both the 1997 book The Fourth Turn, a prophecy about America, and the 2001 Nobel laureate Stiglitz's book The Sound of the 1990s. It can be seen that in the face of new phenomena, most people are often caught up in past knowledge and unable to understand and master it. Therefore, it is necessary to have a new set of theories, especially to explain the various characteristics, laws, and new sources of value of financial civilization. Relevant content has been analyzed by F. and has been sorted and compiled into a book, which will be published in the near future. Please pay attention to it, and on this basis, guide it with wisdom. Secondly, in terms of the laws of financial capital movement, the outbreak of crises is not only artificially manipulated and distorted, but also built in. Fokker has always believed that the market economy is inherently guilty of excess evaporation, especially in the free and open financial field. The financial crisis has never been interrupted for 10 years, as evidenced by the Latin American crisis and the crisis of U.S. savings and loan institutions in the 1980s, the European exchange rate crisis and the Asian financial crisis in the 1990s, and the Wall Street to investigate its root cause, stealing forbidden fruits. The human weakness that cannot resist temptation inevitably leads to excess for exchange or trading. When the transaction becomes complex, human beings are often troubled by their own bounded rationality, at a loss, plant in the seeds for the evaporation of positions. That is, financial transactions must lead to money surplus, and the surplus will evaporate. Recently, Greenspan publicly admitted that his view that banks will do their best to protect the interests of shareholders out of their own interests was incorrect, essentially because he did not see the original sin of finance and ignored the weaknesses of human nature. Finally, whether they are flocking to Wall Street or sneering at it, they still cannot be separated from either this or that. Neither right nor wrong. The One section of linear thinking is that understanding financial capital represented by Wall Street requires thinking in more dimensions and at a larger level. Firstly, finance fundamentally affects today's human economic activities. Why has China's money increased over the years of reform and opening up? It is not only the material wealth that has greatly increased, but also the modern market, property rights market, stock market, real estate market, and financial industry that have revitalized, flowed, and realized the previously static land, natural resources, and even the potential future income of individuals and enterprises in China. In other words, when people are indignantly attacking Wall Street, they forget that the so-called wealth and profits they passionately pursue mostly come from the creativity of financial capital. Secondly, finance has also partially changed people's production, trading, innovation, and lifestyle. From commodity pricing to enterprise risk management, the financial market plays an important role. After the dot-com bubble burst, a group of global leading high-tech companies grew up in the United States, showing that finance promotes innovation. Paperless money, wealth management, etc. are also increasingly becoming a sustainable and irreversible way of life. In summary, it can be seen that this financial storm is actually an evolutionary process created by humans and then counteracted by them. Just like the climate crisis to industrial civilization. Correspondingly, it also means that human beings are